All right, let's jump right in. Today, we're digging into a company called Targa Resources. Its ticker is TRGP, and it's a real powerhouse in the world of American energy infrastructure. Now, if you're an investor, this is a fascinating story about a company that's completely transformed itself, moving from a kind of high-risk play to one with stable, visible growth. So let's break down exactly how they pulled it off.
Okay, so let's start with the big question. How do you get a piece of America's most valuable energy basin? The Permian Basin. It's basically the engine of U.S. energy, right? And for investors, finding a way to tap into that growth is a huge deal. But instead of trying to pick the one winning oil driller out of hundreds, what if you could own the essential infrastructure, the very arteries that every single producer in that basin absolutely depends on?
Well, that's where the midstream energy sector comes in. The best way to think about it is like a toll road for oil and gas. These companies own the pipelines and the processing plants. And here's the key. They're not gambling on whether oil is $100 a barrel or $50. They just collect steady fees for every bit of energy that flows through their system. And what that gives you is a business model that investors absolutely love: stable, predictable cash flow.
And when you talk about the Permian, Targa Resources is, without a doubt, the king of this toll road system. They are the single largest processor of natural gas in the most important energy hotspot in America. Their network of pipes and plants, it isn't just huge, it's absolutely essential. You just can't go out and build another one like it.
So just how stable is this business? Well, take a look at this. More than 80% of Targa's income comes from those steady, fee-based contracts. Now, for an investor, this is so important to get. It means the vast majority of their earnings are shielded from the crazy, wild swings in energy prices. It's what makes the business so reliable and, well, de-risked.
But here's the thing. Targa wasn't always this rock-solid company. Not at all. Over the last few years, they've gone through this huge transformation. We're calling it their great de-risking. And honestly, this is the real heart of the story for investors today because it shows a company at a massive turning point.
Okay, so let's just walk through how they did it. If you look back to just 2020, Targa had a ton of debt. It was a big red flag for investors, sitting at nearly 5 times their cash flow. But then, they started making some really smart, decisive moves. In 2022, they bought Lucid Energy, which basically cemented their top dog status. In 2023, they took full control of their crown jewel Grand Prix pipeline. And the payoff for all this? In 2024, they earned investment-grade credit ratings from everyone that matters. That is a true game changer.
Look at this. The difference between the old Targa and a Targa of today is just night and day. They went from having high-risk debt to a top-tier investment-grade rating. From being sensitive to commodity prices to being over 80% fee-based. We're not talking about a small tweak here. This is a complete, fundamental change from a risky story into a durable infrastructure giant.
And it all kind of boils down to this number here, around 3.0x. That's their target for debt compared to their cash flow, or EBITDA. For an investor, seeing this number means one thing: the balance sheet is fixed. And that is the key that unlocks their ability to do 2 amazing things at once: fund massive growth projects and hand a ton of cash back to shareholders, all without piling on risky debt again.
So now that their financial house is in order, Targa has totally switched from playing defense to playing offense. The story isn't just about safety anymore. Now it's all about this huge, super visible wave of future growth that they have lined up right in front of them, all focused on getting even bigger in the Permian.
Okay, so let's talk about that growth in real terms. First up, the number 5. That is the number of brand new, massive, state-of-the-art gas processing plants they are building right now. And why? It's simply to keep up with the overwhelming demand from their customers.
Next number for you, $1.6 billion. That's what they're spending on their new Speedway pipeline. Think of it as the superhighway they need to move all the new products from those 5 new plants down to the Gulf Coast, where they can be shipped out to the rest of the world. In one last number, 1.4 billion cubic feet per day. It's kind of hard to wrap your head around, but that is the staggering amount of extra processing capacity these new projects are going to add by 2027. And look, this isn't them just building stuff and hoping someone will use it.
And this, right here, is probably the most important part for any investor thinking about risk. As this quote spells out, this isn't a gamble. This massive growth plan is almost entirely de-risked. It's basically already sold. They're building all this stuff because they already have long-term contracts in hand from their biggest, most reliable customers.
Okay, so a strong balance sheet is great. A visible growth plan is great. But what's in it for me, the shareholder, right? That's the real question. Well, it means Targa has turned into what investors call a total return machine, mixing that awesome growth with big, direct cash payments back to its owners. First off, let's talk about the dividend. They've been growing that dividend payout by about 45% a year for the last 3 years. That is just incredible growth. It's a loud and clear signal that management is focused on putting a growing stream of cash directly into shareholders' pockets.
And on top of that, they're buying back their own stock. And not just a little bit, they're being aggressive about it. Authorizing another $1 billion buyback? That's management basically shouting from the rooftops that they believe their own stock is a great deal, and they're using company cash to prove it.
And listen, this isn't just some vague, fluffy promise. Management has put a real, hard number on it. They're officially targeting a return of 40 to 50% of their operating cash flow directly back to shareholders through dividends and buybacks. That is a powerful, bankable commitment.
All right, so let's put all these pieces together. We've got the de-risk business, the locked-in growth, and that serious commitment to shareholders. But what's the catch? What's the price you have to pay for a story this good? And, more importantly, what could go wrong? First things first, Targa is not a cheap stock. Not by most traditional metrics. You can see it here. It trades at a higher valuation, a premium, compared to a lot of its competitors. But you have to ask why. And the reason is, the market sees that superior, highly visible growth we've been talking about. You know, it's a classic case of paying up for quality. But of course, there are always risks. No investment is a sure thing. For Targa, they're pretty clear. First step is execution risk. Can they actually build all this new stuff on time and, really importantly, on budget? Second, they're heavily concentrated in the Permian, which is great now, but what if things slow down there? Third, there's always the risk of new regulations that could drive up costs. And finally, that premium price tag means expectations are sky high, so there's not much room for any slip-ups. And that really brings us to the final, critical question for anyone looking at this stock. Here you have a company with arguably one of the clearest and most de-risked growth plans in the entire energy sector. So the question is that premium price you have to pay today actually a bargain in disguise for that level of quality and visibility? That's the big debate for investors, and that's our look at Targa Resources.